Okay, let's answer some questions from the last market outlook. On the corporate credit market, maintaining its low yields, is it because some of them are being packaged and sold to international markets that has much lower yielding rates in their own countries? No. These are publicly traded bonds. What you might be referring to are CDOs and CLOs when you say they might be packaged, collateralized debt obligations and loan obligations. No, these wouldn't be within the CLOs and CDOs, and even if they were, the CLO and CDO would be priced on its own basis, regardless of no, I shouldn't say regardless of what's in there. Whatever is in there would have its own particular yield. So let's say you had a loan that was at 10%. It might be in a CDO, but the CDO might be trading at 6.5%. Even though the components might have a different rate on them. So no, I don't think that would be it at all. Let's see. Will you update a similar trade plan or thesis on futures on options? You can treat futures and options on futures like stock and stock options. The same rules apply. You just have to be very careful with the expiration dates, as I explained in the video, that some underlyings are cash settled, so we don't have to worry too much about the expiration dates. Some have delivery of the underlying, and brokers typically don't like delivery. Other than for currencies, they typically don't like delivery. So even though you have an option that may say June, it actually expires in May. So you just have to be aware of when the options expire. But the same things apply. Just pretend the future contract is a stock and it's options on stock. Again, just be aware of the expiration dates. Let's see if I made sure I got everything here. I've been struggling to identify if I should use the actual futures versus futures on options to take profit. For example, past week was very rewarding for holding both short ES, however, left a lot of money on the table. Do you mind just going through one more time? How did you or would you approach this in your trade plan? The options on futures that I'm using are just meant to lower the exposure that I have. It gives me, it's like a rudder. You know what I mean? You have a boat that's going in a particular direction, but maybe you want to change direction just slightly. So the options allow you to lean into exposure or lean out of exposure without having to trade in and out, in and out, in and out of the underlying. So if I think the market is going to be strong today and I'm short ES, rather than covering my position and shorting later in the day, it's easier if I just lower my exposure with options and take profit on options at the end of the day. That's all I'm doing with it. Relationship between the overnight rate and government bond yields. Well, the overnight rate is not a publicly traded rate. Bond yields are publicly traded. So if we think of a yield curve, well, right now it kind of looks like this, with the 1 year, the 2 year, the 10 year, the 30 year. The overnight rate is a range, and it is it's for an overnight repo or reverse repo. It is basically a way of the Fed saying to member banks, listen, if you got to borrow money, don't pay more than 4.75%. And if you're going to lend money because you have extra, don't accept less than 4.5. So there is how you get the target range within there. So that other market participants say, listen, if you want to borrow money and I want to charge you 4.8, you're just going to go to the Fed window and get 4.7. And if you want to lend me money and I'm only willing to pay 4.45, you're just going to go to the Fed window. I'm not going to get this, I'm not going to get this. So it forces market participants to put their overnight rate in between those two. And then all other traded tenors, which is everything on the curve, the 1 month all the way to the 30 year, are traded publicly in the market. These are market determined rates, but the very short end of the curve, the money market rates, tend to play off of wherever the Fed funds rate is. But the long end of the curve, because it has what's called a maturity premium in there, can have rates that fall outside of this particular range. Let's see, portfolio management part 1 video, starting your own fund. Yeah, that's tough to do. Research shows that part of starting a fund, according to National Instrument 31103, means having to register as an advising representative to your own portfolio management firm. True. This means getting a CIM or CFA designation work experience. The alternative, according to my research, is become IROC licensed and manage individual accounts. Perhaps you weren't paying too much attention to NI 31103 or that national instrument. If you want to take consumers' money, yeah, the government is going to ensure that consumers are protected. So you got to jump through a lot of hoops. But if you set up a hedge fund and you restrict yourself to accredited investors only, you avoid a lot of those rules. There are still things you got to do, but you avoid a lot of those rules. But getting a law firm to set up a hedge fund, and then you're going to need an accounting firm as well. You're going to need an auditing firm. You're going to need a prime broker. You're going to need a custodian. That's not cheap stuff to do. Typically, you don't come from nowhere and set up a hedge fund. You've usually been managing assets somewhere else. And when you leave to set up your own fund, there is a book of money that comes with you that you know as soon as you open up your own firm, or at least they call it a shop. If you open up your own shop, you're going to get 40, 50 to 100 million walking with you because you've done such a good job wherever it is you work. That money will walk with you. So, for instance, I have money with a wealth management firm, and this wealth management firm places money with external managers, depending on what they're doing, small cap growth, value, bonds. And let's say there's this manager over here that they developed a relationship, and this manager says, I'm going to set up my own firm. Without me having to do anything, they would just redirect the money to here. So when this asset manager walks, they know that they're walking with significant dollars to start. So it justifies the setup costs of setting up the fund, which all the setup costs are the costs of the general partner, by the way. That is the capital that you use to start your fund. All of that goes for startup costs, which you cannot make your investors pay for, just your ongoing costs. So think about hedge fund. You can avoid all that. However, you need a reputation. You need to be able to walk with some money, because this wealth management firm, if you show up and you say, hey, I'm new, give me some money, they're going to say, we are responsible to this person over here. Who are you? Show us your results. What kind of track record have you got? What are your current assets under management? What's the capacity of your investments? I mean, the due diligence on that alone. So it's hard. It is a crowded field. I think there's something like some 80,000 hedge funds globally. I think there's like some 120,000 mutual funds globally. Something around those numbers. It probably may even be higher than that, with the majority of the hedge funds being US based. It is a crowded business to get into. Let's see, I'm wondering what happens to capital adjustments on tips when there are revisions. Tips are paid semi-annually, and there are revisions to CPI every month, with major revisions, I think every 6 months are the major revisions. So whenever tips are adjusted, all the revisions are already booked. So all of them are already there. And from month to month, you can have this kind of revision going on in the numbers, but over a 6-month period, they tend to be fairly stable, and inflation tends to simply move up over time, just at different speeds. But all the adjustments, because it's over a 6-month period, typically smooth out. Let's see, could you please have more artwork explaining the process that goes into this weekly update? The one in Rates Top Down series helped, where you had a goldfish. I don't always see the picture in my mind. Sometimes if I have a complex story to explain, I can see how I can draw a picture, but other times math does the job, and no need for a picture. But I'll try to draw more. Let's see, I noticed JEPI had a good year compared to SPY. What really interests me is the equity linked note, or in Canada, BMO call it structured notes. I did look up, and I think these are unsecured notes issued by banks. If I look at the credit rating, they are BBB plus under their sponsored bank. My question are, could you help me understand how banks would make money by selling linked notes? Are they some kind of fix for equity swap? I'm not familiar with JEPI, but I think what you're referring to are the those linked notes. It's a source of funding for banks. It's a structured note in the sense that you'll get some kind of rate plus maybe some equity participation, and the rate that you would get is lower than, or at least would be probably on par with whatever their wholesale cost of funds are, but not what you could get in the market. What makes it interesting is you're going to get this note with some potential equity participation. And then they just take some extra funds. They buy call options on the index, maybe 3 years out or whatever maturity is, and it's the call options with paper. You can pretty much structure your own note if you want to, but I'm not familiar with this one. Let's see. Regarding US trade example, after closing 42.50 call positions, realizing 30 points gain per contract, would you consider selling calls again? Yep. I would. If market conditions change to the upside in the next few days or weeks, I would. I'd go back in because just because I covered my calls doesn't mean the market and the economy says, oh, well, okay, we're going to get better from here on in, so don't do it again. No, it's not over. It just, we have volatility. And when you have volatility, you have to trade tactically. Especially if you have short positions, you have to trade tactically. So, for instance, yesterday I saw the weakness in the market, and I didn't hesitate. I just hit it with 10 short contracts for June without thinking. I just thought, I see the weakness, I'm just going to do it. And I got, let's see, 20, I did at 40.24, 40.25, covered around 7:30, 8 o'clock at night at 4,001. So I got 23 points out of the, how many did I have? I had 10, I think. I had, yeah, so it worked out pretty good. But you got to be tactical like that. Let's see. What is the plan to manage original ES position? If hypothetically market going to rally in the next month toward 42 or so, be on your 41, 47 average price point, or be on break-even price. Yeah, so it does. I don't see that as a major risk, but I'm aware that it could, and if it does, great. It gives me an opportunity to probably short again, short more. I'd like to see it go there. If it does go there, it's for one of two reasons at this point. It's because the US dollar starts weakening again, or it's because yields start going down again. Now, if yields start going down again, well, I'm long duration. If the US dollar starts to weaken again, that's okay because I'm long the yen and I'm long the Canadian dollar against the US dollar. So all those things just benefit me. If that doesn't change, then my my short beta position plays out. So what I do when I'm thinking about how to or what positions to take is you can look at positions in isolation. You know, you could say, well, I'm going to have position 1, and then I'll take position 2, and then I'll take position 3, and then I'll take position 4. And if you're not paying attention, you may find that the correlation that you have with all of these assets, that your correlation is greater than, let's say, 0.7 or 0.8, that all of these positions are very highly correlated, that they all go up together and they all go down together. What you want to do when you're taking positions is take a portfolio perspective and say, okay, well, if I'm going to be short beta, I'd like something to offset that. Well, long duration can do it. the US dollar has such a high correlation with everything right now. Well, how do you want to position the US dollar so that it benefits you in other places? So I'm short beta, but I'm long beta, dollar, delta, beta when you consider the long positions I have in miners, in home builders. I have Ford. I have, let's see, for duration here, we'll say I'm long agency as well. This acts more like a bond. And I do have some REITs as well. So if the market moves up, it'll probably be because interest rates drop or the US dollar drops. Well, if interest rates drop, my long duration does well. I don't do well here, but my long portfolio does well. And agency would do well. So I take a higher level view of the portfolio, and I have these risk factor exposures that have these negative correlations. And when you move up to the level of the portfolio and you start playing with the broad asset classes, especially commodities, if you have energy, if you have metals and material, if you have some of the ags, you have some Forex, you have beta, you have delta. The correlation among these tends to be very, very low. So you can actually build a portfolio with with maximum diversification because of those low correlations. So if it does move up, it's not like I have one single position that I have to go, uh-oh. If it moves up, other things will help me. Let's see. You're looking at good art when it's open to interpretation. I'm going to use this next time I draw something terribly. Okay. Let's see. I believe TLT was down 1.4% week over week, not 0.51. Okay, maybe I took the wrong date as the closing date. It didn't. I don't think it was down 0.51 because my positions, my gain and loss barely changed week over week. Even though there was lots of intraday volatility, I didn't change week over week. So we'll see. How do you prefer set up the IBKR to follow the market? Do you prefer tabs per asset class? That's what I do. I have a tab for futures. I have a tab for treasuries. I have a tab for equities. And I break them up depending on whether or not I am ready and willing to buy those particular equities. And then I have another tab which are not equities that I'm ready and willing to buy, but equities that tend to set the tone for the sector in whatever particular sector that they happen to be in. And so because they set the tone, it's important to keep your eye on them because they're big enough that they can, if you see a sector that's really doing poorly, is it because the whole sector is doing poorly or is it because the big guy in there is doing poorly? So you click on the other tab and you have your bigger stocks, and it automatically re-ranks based on, because I have it set up such that it re-ranks based on the biggest loser to the lowest loser. And if we were in a bull market, it would be opposite, highest winner to lowest winner. This way here, I can just look at the top of the chart and say, okay, that explains this sector. I know why this sector happens to be down. Live Q&A. I also have even considered a forum and another platform where your viewers can interact between them. And investing can be a little bit lonely, and connect with like-minded people would be great. Yeah, I think that it helps sometimes when you have some people where you can bounce your ideas off of, because other people will pick out your blind spots in case you haven't already seen them. I've done that a few times with some people, and more peers, not people looking to learn, but with peers. And I find that if you point out, you say, okay, well, I like this, but here's, this is what would bother me, is you get yeah buts, and it's like, okay, you're not open to my view of where I see risk. You're really pushing your idea on me with a lot of yeah buts. So if you're going to get involved with a group of people, 3 or 4 people, and maybe every Sunday you're going to bounce ideas off each other, listen to the objections. Because the yeah but means you've already fallen in love with your position, which means you probably don't see the risk, and you're not interested in all the blind spots. You just want everybody to tell you what a great idea it is so that you feel good about it. So just be careful of that. Let's see, Tuesday, and there's been a wild move on ZB with prices dropping 125 to 124. I haven't seen any new macro information that could influence this. Rates. If yields change, TLT changes. That is the only thing that affects TLT is the yield curve. There are no earnings. There's nothing involved in this. It's a portfolio of treasuries with duration. That's what TLT promises you, is big duration. And it is changes in rates. There's only one story with TLT, and that is changes in rates. Let's see, do some just arrive at the game slowly? No, TLT's portfolio would be repriced during the day as yields change. The prices in the portfolio would change, and TLT is an ETF, which means it will hold very closely to net asset value, so that the price you see are not people arriving late. It is just changing. Well, I guess you could say it is people arriving late to the Treasury trade. So they may say, well, okay, well, the 10-year to the 20 to the 30-year yields are too low, they should go higher. And then the next day you have market participants coming in saying, yeah, I've thought about it and they should go higher. So maybe they're late to the Treasury trade, but the TLT trade is purely a function of the yields on Treasuries. So yields up, TLT down. Let's see. Okay. What would be a good split of allocation for this year, short versus long duration, nominal versus inflation-linked bonds? I think you could do barbell. I don't know that there's anything interesting in the middle of the curve. Short and long duration. Long duration because if something happens in the market and something breaks significantly, or there's some contagion effect from some emerging market that hits developed markets, rates can drop very quickly on the short end. So you want to be in duration before it takes off, but it can be a lonely place to be out on the far end of the curve, right? But I think a combination of the two. I don't know about inflation-linked bonds. I'd probably go with nominal. The market for inflation-linked bonds is thin. I shouldn't say thin, but it's not. There's not a lot of them out there. Okay, where are we next here? What is the impact to Macaulay duration and modified or effective duration in an increasing interest rate environment? Let me see if I could draw a picture for this and then give you sort of a general answer. That if we're thinking about time to maturity, and you're thinking about duration, for a zero coupon bond, you could draw a 45-degree angle. We know that, right? Its duration, its Macaulay duration, is its time to maturity. Premium bond, discount bond, kind of looks like this. So let's take a particular point in time. There's your premium, there's your discount, there's your zero coupon bond. And this is duration, right? So you can see the premium bond would have a lower duration than the discount bond, which would have a lower duration than the zero coupon bond. So here's the general answer. If you start raising interest rates, premium bonds would rise to become discount bonds at some point. So if you have a bond with a coupon of 3% and interest rates are 2%, you've got a premium bond. Well, if interest rates rise to 4%, this premium bond will then move into a discount bond, which would increase the duration. So hopefully that answers your question in a very general way. As interest rates go up, all prices go down, so premiums become less premium or even flip to discount, and that's what would happen. On the opening slide, can you add number of days inverted to the yield spreads table? I already do. I write them in. I think you mean actually add them into the table. I don't know that really is going to be worth it, because at this point in time, it's important information. But for many years prior to 2022, it simply just wasn't relevant information unless you were a bond trader. then you were trading different parts of the curve, or you were trading more the structure of the curve as opposed to anything else, I don't know that it would be useful much beyond, this next little period while it's inverted. I'll just keep writing them in by hand. Best art I've seen. Very good job. It is good art. Let's see. The yield difference between AA and the 6-month rate. Would the reinvestment risk not explain it? If I buy the 6-month rate in 6 months, I should make new investment, but I don't know where the rate's going to be. But buying AA bond, this wouldn't be the case. Well, you can make that case, and I think it's a cleaner case to make for treasuries. You can buy a 1-year treasury, you could buy a 10-year. Why would you accept the lower yield on the 10-year? Is because you don't think you can roll over a 1-year for 10 years and get the same yield if rates dropped. So let me draw out the curve as we see it now, and I'll just draw it out to about the 3-year. How's that? The forward curve would sit kind of like that, probably. Now we're expecting another 75 basis point increase. So the forward curve is going to go up, but all bonds right now are priced on the current par curve. Well, you'd have a spot curve that would sit somewhere like this, and then your forward curve would be above it. So let's say that you have a 1-year holding period. You can take the current 6-month rate right now, and based on rate expectations, roll it over into a 6-month rate that is going to be higher. This is just staying with the treasuries. If you take if you have, again, your same 1-year holding horizon, and you go with a AA that has the lower yield, and let's say that your AA, your average is, let's say it's a 5-year that you're looking at, and you're going to have a 1-year holding period. Well, in 5 years, the AA will be a 4-year and will be priced out on the current spot curve at that time, which is anticipated to be what the current forward curve is, which is this one. But if rates are going up 75 basis points, it may look like that, which means you're going to be looking at a capital loss on that one. So because we're expecting the yield curve to rise above where the current forward curve is, a shorter holding period makes a lot more sense than a longer holding period. That the AAs are not pricing that in, to me, seems rather odd. The other thing that you have to look at, since these are AA, is when you take this and you add the next thing I say onto it. If you look at the current slope of the OAS, you can look at the 1 to 3 year range, the 3 to 5 year range, the 5 to 7 year range. The current OAS is doing this. It is upward sloping. So even though the Treasury curve is downward sloping, the OAS is upward sloping, which should make yields slightly downward sloping. It is common to get downward sloping curves, but typically in high yield. IG usually has upward sloping curves that may flatten out in a good environment, but typically upward sloping. High yield can have negative sloping curves, which means that you're going to pay, you got a much higher OAS for a shorter period of time than you do for a longer period of time. And I heard a commentator point that out, that currently the OAS on short-term high yield is higher than on long-term, with the statement of why, clearly the market's wrong. Why holding debt longer is riskier. Well, not really. If you map it to the business cycle, right? So if it's short-term debt, it's something that's due in the next 1 to 3 years. Well, if you're expecting bad economic period, the principal payment is due right when it's questionable whether or not it can be rolled over, whereas for the longer-term ones, it's only interest. So the interest coverage ratio, we're good here, but the debt coverage ratio, how are we going to cover this debt with cash flow in the next couple of years, may be very in question, right? Whereas the principal is not due till over here at an expansionary period. So if you anticipate a recession in the next couple of years and then expansion, you could have a credit curve that is reflecting a tough economic time or a tough credit environment for rolling over debt. Whereas this is reflecting a better time for rolling over debt. So when you map it to the business cycle for high yield, you can get this, but right now for investment grade, it's upward sloping. So if the further out we go, the higher the OAS, we should each amount added to the downward sloping curve should increase that OAS. Not only that, combine it with what I said about the expectation of the forward curve probably increasing another 75 basis points in the 1 to 3 year range. Any AA that you buy right now is going to have price risk, but the 6 month is not. So if you have price risk in the investment grade, even let's say a 3-year investment grade, if there's going to be price risk in the 3-year investment grade, why should it yield currently now lower than something that will not have price risk? Do you get what I'm saying? Given that the OAS for AIG is upward sloping right now, it seems like a very curious thing to have. That's, what do you think about meeting the management team of companies? Well, I certainly would want to know who is on the management team of companies, right? You kind of want to know who's there. Appreciate that it seems like valuable opportunity, but at the same time, due to lots of regulations, they can't actually tell you something that others don't know. Well, it's not that they can't actually tell you something that others don't know. Sometimes they don't know that they're telling you something. Sometimes they don't know that they're giving something away. Sometimes they, might say something and, as they're talking, try to cover up what they said. Everybody's human. There are always slip-ups, and it's always worth meeting with them. You're going to go in prepared. You're going to have your list of questions. If they can't answer some of these questions, or the answers to the questions keep changing as you keep asking them, there's something going on there. So if you start the conversation with a discussion about margins, and then you let the conversation meander somewhere else, and then you come back to the conversation about margins, you should be getting the same answers. If you're getting different answers, this person's just making stuff up. Something's going on somewhere. So it is worth meeting management, even though you may not get information that you can't find somewhere else, just to gauge their credibility. How well do they know their industry? How well do they know the business? How far afield does their knowledge go? Are they aware of what's going on with interest rates? What is their sensitivity to changes in rates? All of you can get something more out of meeting with management than you can just by reading transcripts. You can get something more. So I certainly would say, yeah, every time you have an opportunity, go ahead. So my question is that if you could meet the CEO, CFO of the companies you invest in on a semi-annual basis, what would you focus on? Would you even choose to have such meetings? Probably not. For someone like me, probably not, because I don't take a significant enough position in the company that if something goes wrong, it's going to significantly hurt me. And I'm not digging for that kind of alpha. When you're running a fund, a significantly large fund, every little edge you can get helps. Every little edge you can get. For someone like me, I don't know that it would change my mind. I don't know that it would do anything. And it's hard to find any management that is talking to a prospective investor that is going to be anything but bullish on their company. They're going to be bullish on their company. It's like saying, listen, before you decide not to believe in God, wouldn't you want to talk to some priests? Why? Why? I know what they're going to say. I already know what they're going to say. They're going to be really bullish on the concept of God. I already know what they're going to say. So sometimes, it's like politicians. Why even interview them? Why even ask them questions? You know what they're going to say. No matter what you ask them, they're going to say, well, what's more important is let's look at how bad the other side is. So you could make the argument that, well, You're going to get the bullish story from management. You'll never get the bear side of the story, which is probably true. I just wanted to ask if it was possible to upload these videos before Monday as the last thing on Friday, or if possible weekends. I try to get them up Sundays. Can't do them Friday nights. You simply can't do them. Because you were in the market on Friday, it's still with you. You need to sleep that off, and then you need on Saturday morning to look at your data with fresh eyes, without the market weighing on you. And then once you compile all of your data, you need to think about it. You can't just, if you're compiling your data with a story in mind, you will find data that matches your story. So you have to take the data for what it is and then think about it. And usually that involves sleeping on it, which means by the time you get up Sunday morning, the market is way behind you. The data that you compiled, you've had time to think, and your subconscious works on it. So when you get up Sunday, you have your coffee, maybe you'll watch Wall Street Week, maybe Real Yield, maybe another podcast, just to see what other people are saying, to see if it makes any connections in your mind that you haven't thought of, and then you're ready to go because you've let it sit in. It's you've digested it. Because sometimes you got to change your mind. Sometimes you have to say, well, I still think this in the long term, but the short term, I got to change my mind. So, for example, during the last week, I've ditched quite a few of my REITs. I've simply just changed my mind, especially office REITs. I'm completely out of office REITs. Even some of the ones that I thought were fairly safe, I just thought, no, let's just get out of them altogether. And they're all down. I don't know if it's a function of the REITs or the function of interest rates, but it takes time. You have to reflect on things. So to close up the market at 4, compile all the data, and get a video out Friday night, number one, it wouldn't be very good. And number 2, by the time Sunday came around, I'd want to delete it and do it again because I would have reflected on things a lot more. So Sunday it's going to have to be, unfortunately. Okay, this next one I had to pause the video and go check what I said because I don't think I said this. Would you be able to further explain how inflation only hurts the investor class? And I thought, I don't know if I said it. What I said was, if you have a high level of inflation, it's going to hurt asset prices. Well, that only hurts the investor class. So it is the effect on asset prices that hurts the investor class. It's not as if inflation only hurts the investor class. The investor class are at the heart of it still income earners and consumers. They would feel the same thing everyone else feels, but asset prices would have a problem. I couldn't understand how you'd have the same opportunities at 18 to 20x as 10 to 12x. Well, I'll give you a very simple example. Let's say you have a market trading at 20x, and that same market suddenly is only trading at 10x. Meaning that investors are not willing to pay 20 times earnings. They're only willing to pay 10 times earnings. And let's make it simple. Let's say earnings are $2.50. In a strong growth environment, if you're willing to pay 20x, you're willing to pay $50 for this, but only 25 for this. So let's say that earnings go up to $3. Well, this will go up to 60. This will go up to 30. Well, that is a 20% increase, and that is a 20% increase. It's your return will be the same on the money that you invest. It's just that instead of buying, let's say, 100 shares at $500 for $5,000, you're buying 200 shares at $25 for $5,000. Or instead of holding 10 companies, you now hold 20 companies. That if you suddenly showed up and the market were trading 10 to 12 times earnings, what is the difference between if you suddenly showed up and it was trading 20 to 22 times earnings, let's say? What's the difference? Everything is half the price. That's all it means. A 10% increase in price is still a 10% increase in price. Your returns would be the same. It's just what you don't want is to hold a market at 20 and hold it all the way down to 10 because your 50 then goes to 25. That's what you don't want. You'll lose 50% of your value. You'd like to get out at 20 and get back in at 10. But if you get in at 20, your first year return under both, if we assume normal market conditions again, or normal economic conditions, you should be able to generate the same return. It'll just be on lower prices. I'm looking to establish a short position on ES June. Do you think it is now too late? Well, I'm not going to, I don't think I want to answer that. If not, do you think it makes more sense to wait till it hits 46? Okay, this is starting to get to telling you what to do and giving you investment advice instead of educating you. I'm really trying to focus on, sort of giving you a way to see things such that you can then make up your own mind instead of, if I say no, it's not too late, it emboldens you. But what if there's a 100-point rally before there's a sell-off and you can't handle a 100-point rally? You're going to blame me for that kind of stuff, right? So I'm not going to give any advice. I would just say, based on your own research and your own comfort level and your own level of risk, how do you feel about it? Can you handle a $5,000 move against you? Because that's what 100 points would do, put you down $5,000. If you can't, don't do it. Use something smaller. Use MES, which is 1/10 the size of ES. It is the equivalent to 50 shares of SPY. Hang out there till you feel comfortable with it. Learn how to use the options to manage your risk, such that if you were in ES, and you said, okay, well, I can handle 25 points up, but then that's it. Well, if it goes 25 points up, use an option to rebalance your risk level so that you never have more exposure than what you originally signed up for. You can rebalance. If you are uncomfortable doing that, or if you don't know how to do it, I would say don't chase reward. That is the wrong thing to do. Always invest with risk in mind. Always manage your risk. Reward will take care of itself. Manage your risk. Either take on risk when you want to take on that risk, or reduce risk when you don't want that risk. So if you short ES, it's because you want negative beta. If it moves against you, at some point you're going to have to say, okay, well, I need to get this beta closer towards zero. Which means you're going to have to add some positive beta somewhere. Maybe you don't want to get it right to zero, but you're going to have to add some form of positive beta, which is typically with options, and you manage the level of risk. Return will take care of itself. So I can't answer this question for you about when you want to get in or when you should get in. You're going to have to, that's something you got to come to on your own. For the double A being higher than the 1 year, aren't you looking at 4.93 away from more? Well, I already answered that. Does Fed have any target for what they want their balance sheet to be at the end of QT? I'd say prior to, like, you go back to 2004, 2005, I think it was around 400 billion. So I think that if they removed all of the QE exposure, all of it altogether, I think they'd be somewhere around that same 400 or 500 billion. I don't think they're going to get there, but I don't think they have a target other than just it's too early to have a target when it's 75. When what are they, 75 billion a month, 95 billion a month. It's too early to have a target with 95 billion. Their target for MBS, I believe, is zero. For anything other than treasuries, the CMBS and the MBS, their target is zero. They would like to get that all the way down. Non-expert, the fact that AA is yielding less than 1 year T-bill could be related somehow to the difficulties that may arise with regards to the raised debt ceiling. Well, the all corporate bonds have within them the Treasury yield. Number one. So when I say they have within them the Treasury yield, it's called a G spread in a very naive way to do it. So let's say that you have let's say the yield curve looks like this, and you got a corporate bond here. And here are the two tenors on either side of it. You can interpolate what let's say this is a 5 year, this is a 7 year, and you're looking at a 6 year corporate. Well, there is no 6 year on the run bond. You can take the 5 and the 7, you can interpolate what the 6 would be, and the difference between this is the spread. It's called a G spread. It's not the OAS, but it's a G spread. The OAS gets a little bit more mathematical, but it's based on the same basis that within the corporate spread, you have the default risk-free spread that you can get from a government yield plus the OAS, such that if there is some concern in the Treasury market about the debt ceiling, it is going to find its way into the corporate yield. So it would already be in there. So no. What's the maturity on the corporate bonds you show on the rates section? Does it make sense to compare them with short-term government yield? So I've answered that quite a bit. Do you sell 10 or 20 deltas against your TLT long calls? 50 deltas, basically. I get aggressive. Afraid to do that because there are signs of recession. The move upward will probably happen very fast. Do you sell 10? Okay. Whoa. I do not sell calls against my TLT long calls. No. I sell puts again so 50 delta puts. I don't mind being aggressive because I don't mind the underlying being put to me. And you're right, you don't want to sell calls on TLT because if something happens and rates have to drop very quickly, you could get crushed. No, you don't want to do that. I have trouble understanding the importance and impact of the reverse repo facility. You mentioned it could become an issue, but I don't see why, and I think there's a whole lot about this reverse repo that I don't understand or fully appreciate. Watched the last Q&A where you went over it quickly, and perhaps there's another Q&A where this has been discussed extensively, but I probably missed it. Yeah, I did over the last year. I think in one of the market updates describe what's going on with the reverse repo market. And basically, it's just that you've got this cash that has no home. It needs to sit in short-term securities, and there simply aren't enough short-term securities that happen to be out there, which is, when you hear the term, there's a lot of money on the sidelines, right? A lot of money on the sidelines, and you can point to the reverse repo facility as, look, all of this money that's found its way into money market mutual funds and into banks, they can't lend it to anybody else. They can't get the yield on it, so they're hitting the reverse repo facility to get some yield on that money. That's money on the sidelines that can come back into the market. That's a bit of a problem because in let's draw an upward sloping curve, and if you think the Fed is going to be raising rates, money starts moving down the curve. And as rates keep going higher, more money moves down the curve. So when you get something like this, a whole bunch of money is shown up in the money market fund, right? Well, it needs a home to go to. And with the Fed balance sheet so large, they have runoff, but the runoff happens with coupon paying bonds first. And if there's still room, they let T-bills run off. So that over time will reduce the stress on the reverse repo because the Fed won't be crowding everybody out of that particular market. But with a debt ceiling looming, other than being able to roll over debt under a certain limit, because if they roll over debt plus interest, every rollover's got to be less and less. Once you hit that debt ceiling, there's going to be even a bigger shortage of money market securities because you can't issue anything new until you have a new debt ceiling. So that is all money that is flowing out of the Fed into the balance sheets of mutual funds and banks at this point in time. So the idea that, well, there's a lot of money sitting on the sidelines as a reason for why the equity market will go up, that money did not come into the sidelines from the equity market. It came from, well, I got to get out of duration. Let me get shorter duration until all that money's sitting in money market funds. That if rates go down, where's this money going to go? Back out the curve. It's the idea that all the money on the sidelines, is a signal for equity markets to go higher. Well, maybe it's a signal for bond markets to go higher, right? Any reason why chain dollars use 2012 as a base year? I think they reset it every 10 years, or every so often they reset the base year, but all it is just you pick some year in which prices stay the same. It just resets, as opposed to continually using, 1932 as a base year. Your price index would be, 65,223 as opposed to 200 and something or 240 something. So it's just, 175 or whatever the price index happens to be at. So it just resets it every now and then. It wouldn't matter what base year they used if you're calculating a year-over-year price index. Now you may say, well, what happens to everything before? Well, let's just say that here is 2012. And 2012 is 100 because that's the base year, and so price index went like this. So if you extended it after and you looked at 2008, it would be like 84. Whereas in 2008, if the price base year were 2008, well then that would be 100 and everything would be above. And then if you went back to 2002, it would be lower. So all it does when you reset the year 2012, you set it to, let's say, 2020. Well, now this turns into 100. Nothing changes on this curve. This changes into 100, and then mathematically they just say, well, if this is now 100, then this must have been 90, this must have been 80, this must have been 70. So the difference between them would still be the same difference between that, if 2012 were still the same base year. So it doesn't affect the calculation of any period over period percentage change in the index, because mathematically they preserve all those changes. It just rechanges the base year. Could you explain if we can apply all the option strategies as per the applied series on ES? Yes, you can. Just treat ES like a stock, and you can do everything. Yeah. Let's see. Excellent. Risk management in the applied series really helped to see my mistakes in my Tesla trading. The biggest mistake on the Tesla trading is you shorted something which can't be shorted, which is a fan base that is absolutely willing to look past valuation. You can't short that. So you're not shorting fundamentals anymore when you short Tesla. You're shorting an image. You're shorting an ideology. You're shorting a mindset that buys in to the story 100%. That buys into the idea that by 2030, Tesla with their two vehicles will be 33% of the market. You're buying into that, and you just can't short momentum, not momentum like that. So I think slowly, the fan base is starting to realize that what Musk says is not always what's going to happen, but just stuff that he says. It's kind of almost like a Trump figure. Not that I'm comparing him to Trump, but Trump could shit on the American flag in the middle of Times Square, and he wouldn't lose a single one of his supporters. For those that support him, he wouldn't lose a single supporter, no matter what he did or said. Musk is the same way. It doesn't matter if what he says sometimes is just horseshit. He's not going to lose anyone. I mean, he can say full self-driving is just around the corner, and okay, whatever. Whether they believe him or not, it wouldn't matter. You know, it wouldn't matter. You can't short that. You just can't short that kind of thing. So risk management would have said, don't even try shorting that, even though fundamentally it doesn't belong there. It's not trading on fundamentals. I still have some doubts in your video. Use the example of owning the stock and selling calls to lower the delta. In my case, 100 shares of Tesla stock would be too much weight for my actual portfolio. Then you should not have been there at all. This is why I plan to just sell calls and puts with really low delta for high income. Yeah, that's just a dangerous thing. Rather than having one stock with high implied volatility where you think, well, low deltas will give me higher income, find 4 or 5 stocks that are better in terms of the fundamentals and have a much more reasonable implied volatility, like anywhere from 35 to 45%. For example, pick seems to be a nice one to play. It doesn't move a lot. GM is fairly nice to play as well on that one. In the 40s, Oxy is a nice one to play. If you get into the 50s, Alcoa is a nice one to play as well. They're not exciting names, but you don't want them to be exciting. If you're playing for income, you don't want exciting names. You want these kind of boring names where, well, they're fundamentals of the economy. They'll only go down so far and they'll only go up so much. That's your income play. There it is right there. That's what you're looking for on the income plays, are companies like that with very good management and long track records. The latest and the hottest stocks, or the stocks that have these large followings, these sort of fan followings, stay away from that. I mean, those, even from a trading perspective, I would say that, if you take everybody from 2020, 2021 that made money on Tesla, the vast majority of them gave it back in 2022. And that the ones that had the 100% return in the last 3 months, 4 months are probably a different group of people, and they'll continue to play it until they give it all back. So be very careful about those kind of stocks. If we're looking to earn an income, we don't want those. We specifically don't want those. You want things like BHP, Rio, Freeport, PIC, General Motors, Oxy, Alcoa, these real titans that have been around for so long. They are great for making income. And if they do have to be put to you, it's not that bad, because most of them have a dividend yield. Oxy raised its dividend and did a $3 billion buyback, even though its earnings were below the target, and it went up. Because of that, it went up. That's what you want. You want these kind of companies. That's where you make income. And then you play your 20 delta, your 20 deltas on either side, or your 15 deltas, whatever you're comfortable with, and just have more of them. And you sleep well at night, and you earn. You consistently earn, as opposed to these big hands that you play all the time. I would advise you highly to get boring. I want your life to be far more boring. If you're looking to generate income from options trades, you can do it, because it is a game of numbers and probabilities, but stay away from this stuff. Do you mind explaining what OAS spread is and how that is useful? The OAS is, I can try to explain it, but when you have a straight bond, the OAS is nothing more than the Z-spread. So let's take a yield curve. And actually, let's call this the spot curve, not a par curve, but a spot curve, which means that every rate is a single period rate. And you take each cash flow from the bond, and you get the present value of the bond. If it's a credit risky bond, there'll be some constant spread that you add on to each of these spot rates, some constant spread. Well, that is called a Z-spread. And you adjust the Z-spread until you recover the price of the bond. Then you know what the Z-spread is. If a bond has an option, whether it's a callable bond or puttable bond, depending on if the option is in the money, it will squeeze out some of the Z-spread. So a call option that's in the money will squeeze out some of that Z-spread, and if you're looking at the Z-spread, it will give you the impression that you're not getting paid a hell of a lot of money to take on risk. So you want something called an option adjusted spread, which adjusts the spread for the fact that an option exists, so that you can compare a bond with an option to those without an option. So when you see the OAS, for many of the bonds that you're looking at, they're not callable. It's just a way of comparing it with another bond that would have an option in there. So if you did have an option, you'd need some option pricing model. I'm going to make some level 2 candidates cringe and remember the binomial tree, where you have to then move your bond price back one period at a time and determine whether or not that it's called. And to get your present value, you add a constant spread to each of the forward rates in this tree based on, if an option is called, let's say that this bond came to 102, you would price it at 100 before you backed it out because it would be called at 102. And based on all of the calls that you have, you try to recover the price. That is an option adjusted spread, whereas the Z spread is a constant amount added to each spot rate. The OAS is a constant amount added to each forward rate in a binomial tree to recover the price. How do you like that answer? Probably more than you wanted to know, but it's just a way for us to measure how much we're actually getting paid to take on credit risk without worrying about the value of the option that may or may not be embedded in a bond. Do you think it makes sense to invest in high yield at this time? No, I do not. I think that high yield is overpriced. Will you have a fixed income section in the applied series? There is in the futures section, there is the video for Treasury bonds. So it covers ZT all the way to ZB, the 2, the 5, the 10, and 30. Other than that, investing in direct bonds is expensive and chunky because they're $1,000 bonds each. You can do a lot better by using an ETF that invests in that. I shouldn't say a lot better, but you can access it more efficiently by getting an ETF or by using futures contracts to get that done, as opposed to the bond itself. And a lot of bonds, corporate bonds, you can't trade on an exchange. They're traded OTC. That's a dealer market, which means you got to call a dealer desk to buy the bond. If you're not into that, I wouldn't do it. I see that on TWS for TLT January 10 calls, IBK showing alerts saying it will go X dividend X. Okay, yeah. It's the grammar that they use makes it seem like you should, but it has the word not in there. Options for which early exercise is projected to be not beneficial. You have to look before the word beneficial, there's the word not. This is a long one here, eh? I'm asking this to know whether there's an error in the L1 probability concept. Oh, no, I'm not going through any probability concept video to find that. Where do you get OAS information from? You can get it from Fred. All you have to do, if you don't have Koifin, that's a paid service. If you have Fred, go to Google, type in IG OAS FRED, and it'll give you the yield, the spread for IG. Then type in high yield. Then type in AA. Then type in AAA or triple B. Type in any credit rating you want, OAS Fred, and you will get a chart. I agree that debt won't inflate, but wouldn't having more money prompt people and companies to borrow more? Yeah, that's the one thing that you can always count on with consumers is they are very much like goldfish. They will grow to the size of their environment. If you have somebody who's making $50,000 a year, they will live a lifestyle of $50,000, including debt. If you then get them a job that pays $100,000 a year, they will grow into the $100,000 a year, and they will eventually have debt. If you start giving them $200,000 a year, they'll grow into $2,000 and eventually have debt. Yeah, that's one thing you can always count on with the consumers, they'll have debt. The terrible thing is if you have a period of inflation and consumers are taking on debt and they're taking on debt and they're taking on debt, and then you cause a recession where you have a period of deflation, the debt does not deflate. But they may lose their job, and the next job they get may be at a lower salary. That is crushing. That is crushing. But all of this, by the way, all of this is the result of something that is very, very highly prized. Free choice. If you want to find the underlying, the real, and probably the most significant underlying cause of inequality in an economy, it is free choice. Free choice. Give me somebody for 3 years. Give me somebody who is in a position in life that says, I'm not making any money, I'm in debt, and I don't have any prospects. Give me them for 3 years. I will strip them of free choice. They will not have free choice for 3 years. They will only do what I say they will do. They're not free to spend their money the way they want to. They're not free to spend their time the way they want to. That TV business, that's gone. We're going to substitute that with education. That food that you're eating, that's gone. You're going to eat more healthy and you're going to go to the gym. In 3 years, you will be a different person, a completely different person. It's not the system that's broken, it's you. It's you and your free choice. You have to rule out free choice before you can start blaming the system. And with free choice comes personal responsibility, right? You don't like where you are in life, it's nobody else's fault. Unless you can show me that you did everything right, you show up here with your master's degree in your 5 languages and your 3 instruments that you can play, with your healthy heart and everything is there, and you still can't get anywhere, I will then accept that perhaps there's something wrong with the system. I will then accept that. Until then, you want to blame someone. Blame free choice. So yeah, you're right. If people start making more money, wouldn't the problem just continue to grow with them? Yes, it would. Yes, it would. So being that we get to that conclusion, we can then say, well, then what's the point? Why not just solve the problem down here? Why let their incomes inflate and then solve the problem here? If we're going to solve the same problem and cause the same outcome, why not just solve it here? Be done with it, right? Let's see. If the economy is otherwise holding up fairly well, how does an exogenous shock like a credit event cause a recession if the central bank steps in? Well, here's your word, straight away. They don't step in straight away. Usually something happens that causes significant damage. The damage is already there, and they step in to minimize the amount of damage. They step in after the fact, not before the fact, and not in enough time to shield it. So you and I are walking down the street, and I'm your bodyguard, and somebody it just shows up out of nowhere and starts wailing away at you. They're going to get 3-4 punches in before I can step in. Sorry, but that's just what's going to happen. And that might be enough to cause some damage, but don't worry, I'm here. I'll step in, I'll take care of it. But they're still going to get a couple of punches in. If they got a knife on them, they're going to get a few stab wounds in at the same time. So think about it that way. Also, why do intraday and short-term market correlations often hold up so tightly? And they do. I mean, if you've been watching the market for the last week or so, it is, you get yields up, market down. US dollar up, and oil down. I mean, it almost seems to be very tight that yields are up, market is down, and yields sort of give away a little bit. Markets will start to rally. You'll see the US dollar give up. I'll see the Canadian dollar gain strength. And if I see the Canadian dollar gain strength, I can flip the board over, and I know the futures on the market are up. I can flip over to treasuries and see that yields are down, and I can look over at gold, and I can look over at copper, and everything seems so tightly tied together. Copper up, miners are up. Aluminum is up, Alcoa is up, like very, very tight. So yeah, the correlations are unbelievable. It's almost as if there's one asset class right now. Sometimes I watch SPY and TLT literally holding almost exact correlations over the course of the day. And likewise for many of the other sectors, ETFs and many of the individual stocks. It's almost as if there are literal algorithms holding up the exact betas. Probably a lot of algorithmic trading. You have a period of very heightened uncertainty at this point. Nobody really knows which way they want to go. Well, there's good reasons why we should be bullish. There's good reasons why we should be bearish. Who the hell knows? So everything is almost minute by minute, because with heightened uncertainty, your visibility narrows. So, never mind 6 months out. I can't even see 6 days ahead. I have no idea 6 days ahead. So it becomes hard to play. As a bonus question, do you have a favorite piano concerto? Rachmaninoff, number 2. I liked what he did in number 2. And then he really explored the theme in number 3. He explored that theme much more. But I'm a bigger fan of number 2 than number 3. Let's see. What are your thoughts on using the TIPS yield to derive an equity risk premium? versus, say, true 10-year US yield? Well, the equity risk premium is not going to be real premium. It's going to be a nominal premium. So, well, actually, could you? Here's the thing. I imagine if you went back through time, and whether you use the nominal yield or the real yield, the spread would probably be the same. So never mind what I said about it being nominal versus real. The spread would be constant. It's just that you're changing the base on which you're measuring the difference from. I can only imagine it would be constant. I'm seeing this use, and it makes the current market pricing less demanding. I'd have to see how somebody did that so that I have a better idea, because in my head I'm not quite seeing, unless you arrived at the conclusion that the break-even rate was just a poor proxy for the actual inflation rate in the future. And if you did that, then yeah, probably I can see that. But equity prices are nominal, returns are nominal. To suddenly use a real variable in there, I'm seeing complications. But I mean, I'm not a statistician in the sense that some people who live with it every day would be able to explain it away. So I'd have to see a paper on it to arrive at some conclusion. Could debt ceiling be the reason government bond rates are higher in corporate? Okay, I'll re-answer that. How do you determine the probability of different terminal rates? Fed Watch tool, CME, Google that, and you'll get a link. So it is just called the Fed Watch tool, and then type in CME, and it'll be your first link. Head to there, and at the top there's this thing, and then you have the two different rates, and across the top here you'll see February, and then you'll see March. Actually, February's gone. You'll see March, you'll see May, you'll see June. Click on the June, and you'll have all the rates along the bottom with the probabilities. Let's see, 3 questions. Do you happen to know the name or where I could obtain a copy of the research you mentioned? That is it's answered, but I'll answer it for everyone else. It was a presentation I had done based off my dissertation. American Car Center filed for bankruptcy. It made me think of last week's video. What do you think are the chances a significant enough credit event that pushes the economy into recession comes from the auto industry? I'm not sure. Is this the subprime auto lender? Well, I'm asking a question you can't answer me. I know a subprime auto lender declared bankruptcy in the past week. They were going to do a $220 million bond offering, and then they just said, "No, I'm done." Well, yeah, it seems like it's going to be a problem. Well, subprime. I mean, come on, subprime means subprime. These are not prime borrowers; they're subprime. And you're raising rates. What do you think is going to happen? I mean, what do you think, right? It's like having a keg party in a rehab facility. What do you think is going to happen? Everyone's going to drink. So it's not shocking that it happens there. So I don't know that that's really a canary in a coal mine. More than it's a duh. Well, what did you think was going to happen if you squeezed subprime borrowers? They're subprime. They have low credit ratings and low credit scores. Well, not ratings, low credit scores for a reason. They're a credit risk, and now you're going to make their credit more expensive. Duh. So I don't know if it's anything more than just the typical thing that you would have in lending to risky borrowers in a risky time. In the presentation that you mentioned, did you happen to study the effects of those innovations on inflation itself? That would be hard to do. That would be really hard because these are what are called significant patents. There's a difference between the patent and the actual innovation that happens in the real world. There is a difference between that. So you may have a very significant finding at a particular point in time, and a patent is filed for something. That follow-on innovation may not happen for another year, year and a half, and then there's this wave of innovation that happens. You create a whole, maybe sometimes whole new industries. That's why I took the top 100 patents, because there are literally tens of thousands of patents. So the top 100 is like 0.001% of all patents. These are the types of patents that have spawned entirely new industries. Well, they provide economic growth almost for decades after their discovery. That's why they become highly cited, because even 15 years later, if you're building something and that patent is the basis of something, you must cite that patent in your patent. That's how a citation happens, is follow-on patents happen that cite the original patent for some aspect that the patent that you're filing is excluding. So there may be a patent that said we have discovered this, and then you file a patent saying I've discovered this, but I have to cite this as an exclusion. I discovered everything else, but not this. So you're getting a patent on all this other stuff, but not this. So something that's extremely, extremely significant, as everyone files patents, it forms the foundation of a whole bunch of innovations after. Well, it's these other things that are really innovation. So to measure the effect of that on inflation would be, you'd have to find all the patents that cite that patent, and you'd have to, I'm getting sick just thinking about how much work that would be. And how many grad students you need to get that done. No, I didn't do that. Let's see. On one hand, you have wage expectations keeping inflation elevated. However, I would also expect these innovations to cut costs and push inflation down. It depends, right, on what type of innovation and what it is. There's a difference between radical innovation and incremental innovation. If you have a very highly cited patent, it's more likely to be radical innovation. Incremental innovation is taking something and making it a little bit better, and then making a little bit better and a little bit better, like the iPhone, right? When it first came out, it was radical. Now it's incremental, and the cost of it just keeps going up, even though it's supposed to go down. The cost keeps going up. So I don't know if there's I'm going to leave that, because I don't know that there's so much to pull apart, right? I recreated regression 2 years ago to predict a change in it. Oh, okay. So I've already answered this. The answer to it is there are two different time series here. There's the Fed funds rate, and there's the 2-year Treasury. So it is just a regression. With one, even though they're time series, it's not an auto-regressive model, so the unit root problem can be ignored. I wanted to ask you if you would be including financial modeling in the applied series, something similar to Wall Street Prep, and if so, would there be a section on small cap investing? Small cap is brutally difficult to do financial modeling for, because there's so much uncertainty and not enough history. Unless, of course, it's a small cap stock that's been around for 15 years. And if it's still a small cap stock, and don't know if it's going to be that exciting if it can't grow beyond being a small cap stock. But most small cap stocks, eventually grow into mid cap to large cap. Future is so uncertain. Predictions become, a lot of fantasy. What is more important in modeling small caps is the assumptions. So you have an assumption that you have, along with some current price that you arrive at. Well, you can't. It's hard to say the stock is undervalued or overvalued because of that. But what you can do is look at your assumptions, and as data comes out on the company, if the data is exceeding your assumptions, then you know that you have a stock that's a buy, without having to worry about what its target price is. But if it's not exceeding your assumptions, well, then it's not, and you would update just your assumptions section, and it should cascade throughout your whole sheet. But there's a reason why small cap stocks don't have big analyst followings. It is difficult to be precise. Well, it's difficult to be precise with large cap, but it's difficult to forecast for small cap stocks because there's so much uncertainty that the margin for error in your present values is so wide as to almost not have a lot of value to them, because it's hard to make a good call on them. But yes, I am going to put something in for financial modeling, but for particular companies that you can work with. Small caps, especially emerging small caps, they're tough. They're tough to do. Not that you can't, it's just, they're tough. Small caps usually sell more on their story. So I forget his name now, but if you Google narrative economics, what's his name? Come on, right at the tip of my tongue, and it just escapes me now. He can listen to what and he even has a book out for narrative economics. That sometimes you don't really need all of the fundamental data if you have a good narrative, if you have a good story. Small caps tend to trade on their stories more than their numbers because any numbers are nebulous. So let's see. I believe that retail investors can benefit from investing in that section of the market since there's less institutional funds in these types of companies due to the lack of liquidity and the restrictions firms have in investing in these types of companies. Yeah, but you can, rather than being a picker for a while, you can just grab a small cap index, Russell 2000 or the IJR for the S&P 600 small cap. They're you could probably do some financial modeling on the S&P 500 small cap because they are profitable small cap, whereas the Russell 2000 includes both profitable and unprofitable small cap. You mentioned using 16.6. Okay, I already replied to this, so you can see exactly how I did it here. If the reason I chose 16.6 is because if you're going to use an equilibrium model like CAPM, CAPM is an equilibrium model that shows that the cost of equity or the required return on equity is some function of the risk-free rate plus some exposure to the market, right? You have the equity risk premium and you have the beta of the particular stock. The beta of the market is 1, so risk-free rate plus the equity risk premium. That's an equilibrium model. Well, you have to assume a market in equilibrium as well. Now it's out of equilibrium, there it's out of equilibrium, out of equilibrium. So it's in equilibrium sometimes. Equilibrium is the mean reverting level. Well, you have to use the long-term forward earnings of 16.6 to first figure out what is an equilibrium price on the market now, and then you can increase it at whatever your equilibrium required return is minus your dividend yield, because your dividend yield is part of your return. Then you take this price and you multiply it by, well, if you say 11% and the dividend yield is 1.8%, you got 9.2%, so whatever price you get here, equilibrium price that is, which would be 16.6 times whatever earnings are for the next 4 quarters, you multiply that by 1.092 and you should get a 1-year target price, equilibrium target price. So if you're telling me that the required return on the market is a certain 11%, let's say 10%, 11% based on some equilibrium model, you cannot take today's price, because what if it's up here? Right? You have to figure out, well, what would today's equilibrium price be, and then calculate it. That's how you get to close to 4,000, which is pretty much where we are right now. Your slide on PCE revisions was telling. Why do they even report? You suggest initially reported figures may move markets. Can you speak to why revisions catch these deviations? As more information comes out and as better information comes out, you can better because all of this stuff is based on samples and models, right? So you, as you get more data and more information, you can refine your estimate of what something was with better information. Where you get the data for corporate bond rates, already explained that. You compare corporate AA with 1-year treasuries. Wow, a lot of questions on that. I've already explained that as well. Can you show us where you get the info for Fed funds price term structure chart on the right? For that one, you have to be a subscriber to the CME, which is free. Just subscribe. And what you're looking for is STIR Analytics, which they have a quick strikes tool menu. Drop it down, look for STIR Analytics, and it'll look like this. And you'll have a couple of things along the side. Right over here, you can see FF funds, FF futures term structure. Click on that and you will get that curve in the middle. However, when you click on this, it takes sometimes up to 30 seconds for that page to load, depending on when you're trying to load it. Longer on the weekends, because I think everyone's doing research on the weekends. Okay. It's clear that if my wage grows 100%, but my credit card debt is still the same, the issuing bank and the people who put their money on the bank will be hurt. Yes, that is true. And that's the problem with when you have inflation, is if it becomes embedded, lenders will then say, why would I lend you money at this rate when I know that by the time I get it back, it'll be significantly less? So they'll continue to raise rates if inflation becomes embedded. And when they do that, fewer and fewer people will be able to access debt because it will be too expensive. Smaller companies won't be able to access debt because it'll be too expensive, and you will get underinvestment and under consumption, especially in the interest rate sectors. So inflation has a big damaging effect there, because if I'm expecting a lot of inflation, why would I lend you money just to get those dollars back? I'm gonna charge you a big enough interest rate to protect myself. So yeah. Okay, the rest I've answered in another part. What should interest rate be now according to Taylor's rule? Well, I don't know that it's useful to use the Taylor rule for that. So how it was developed is here's the Fed funds futures. Here's the Fed funds rate over time, and this guy came along and said, I wonder if there's a model that can explain that, and he did, and that's what he came up with is, well, if I use the neutral rate, the nominal neutral rate, and I weight the real GDP gap. This is the real GDP gap. And I weight the inflation gap. It should tell me something about the rate. And if I did this and I use the actual data here, how well does it fit? Look at this. It fits very nicely. So this was meant to be descriptive. And if it's descriptive, the question is, if it explains this very well, can it predict? And if it can predict, perhaps it should be a policy. Perhaps it should be prescriptive, not just descriptive, but prescriptive. Well, Taylor never went that far. He said, aha, there you go. Maybe, but that's not what I'm doing. And it seemed to become a prescriptive tool such that, well, why don't you just follow the Taylor rule? Taylor rule was descriptive of the past, saying, well, is there a way, are there variables that I can put in a model that can fit the backward-looking data very well? Well, there is, but it was never meant to be prescriptive, just descriptive. So this idea of what should interest rates be now, considering the Taylor rule, that's not really what it was set up to do. To be prescriptive, you are going to have to take into effect forward-looking indicators or forward-looking estimates of inflation, not backwards-looking or not actual readings of inflation, but forward-looking inflation. So this fit the model very nicely because you could look at, in the past, you could look at actual GDP and potential GDP. You could look at actual inflation versus the policy level for inflation. Well, looking forward, you don't have this, you don't have this. These are just estimates. So now you're trying to forecast, and now you need a forecasting model for these two things to put in a forecasting model for these things. The errors just multiply. So it's not really meant to be prescriptive. Might be a good benchmark to look at, but not prescriptive. What kind of external events would crash the market? Are we talking about events like supply chain issues or invasion of Taiwan? Well, I think if there's an external event, it would be something that would cut off a key input to the economy, like energy. There'd be some big energy shock somewhere. or a credit event where suddenly credit just everyone gets afraid to lend money and it just tightens up very, very quickly. So one of those two big things. How can we monitor inflation expectations? The the difference between nominal and tips, I think, is a good place to be. How do you forecast? I already did that. Okay. At all possible that the recent debt ceiling chatter, already answered that. Stress in the market is likely going to come from private credit. Private credit is small. I don't know that it will have much of a contagion effect, but it might make lenders slightly more nervous. It is where it would have an effect is the unforecastable spillover effect into something else, and if it does have a contagion effect, then yes, it can. You estimate the Fed balance sheet without SOMA to be around 500 or 600 billion. Why would it be so large? Already answered that. What type of assets would the Fed own beyond commercial real estate? Foreign exchange is a big one. 15 more. Okay. So RRP balance increased week over week because the Fed is offering a higher interest rate. No, not because they're offering a higher interest rate. It's because there's no other place for that money to go, and no one else is. Since I got money, you got money, my neighbor's got money, everyone's got money. I say, hey, I'll lend you some money, and you say, I got money, I'll lend you. No, I got money. We need to find somebody to lend our money to. Well, that's the Fed, right? What leads to an increase in RRP balance? A lack of other places for that money to go. Why is there no real yield at the money market rate? Well, you need some security that offers a real yield. It would be hard to offer a real 6-month yield on anything because, well, it would be a zero coupon. It would just be a discount bond. So here you'd have to just imply one. To get the option adjusted spread to a website, already answered that. One of your videos, if I long a stock and the position goes down, instead of buying more at the lower rate, I should instead sell in the money call to lower delta. Well, that is one thing that you can do, yes. Never buy more if the stock is going down. If the stock is going down and you want more because you wanted more to begin with, then buy more. But if the stock is going down and you're saying, I'm losing money, never buy more thinking that now it only has to go up a bit for me to break even. Never add to your risk when you feel that you've made a mistake. Never do that. Go the other way. You need to add positive exposure. You need to add negative exposure or lower your exposure towards zero. If I'm shorting a stock, let's say like I bought SPY put, and a SPY goes up to manage risk, should I sell a put or buy a call? Well, you bought the put. You have what's called defined risk at that point. You bought the put. The most you can lose is what you paid for the put. That's the most you can lose. So there's not really a lot of risk management you can do on the put. You bought the put. That's it. That's the most you can lose. You already have defined risk on that one. If you would assume, but I'll answer this. If you need to recover some of the money, what you can do is, let's say you bought a put at 400 and the market goes up, sell a put at 395. Yeah, you're not going to get all your money back, but you'll recover something, and now you have a put spread. All right, just sell a put at 395 or some other price to recover some of your money. If you would assume if the Fed is willing to tolerate inflation at 3.4%, what does it change in the artwork? They're not. If I assume that they're willing to accept that, then it's a different picture with different risks altogether. But that is simply not an option at this point, is to change the rules of the game while you're losing the game. Because if they change it to 3 or 4, and they can't get it to 3 or 4, the market's just going to say, well, they'll just change it to 5 or 6. And if they can't get it to 5 or 6, the market say, well, they'll just change it to 6 to 8. They'll just keep changing it to wherever they want it to be. We're okay. We're back in business again. and you'll never get rid of it at that point because the market will just normalize 3 to 4, and that's where it'll be. And if it goes higher, they'll say, well, the Fed will just raise the rates again. Why did everybody say the word pivot last year? Because Powell did that when Trump yelled at him. He turned around, tucked tail, and he ran away. So they just thought, well, he did it once, he'll do it again. So because of his reputation, the market rallied in July and into August because they thought, Powell's going to pivot. He's going to pivot. Look at this press conference. He's going to pivot. He did it before, he'll do it again. And it only caused more damage. Had he been more sincere at the time and came out sooner than Jackson Hole and said, you guys are idiots. You guys are messing this up. You wouldn't have had the loosening of financial conditions that then, when you got to September and October, lo and behold, inflation is back again. Then it started dropping down. Then in December, he wasn't strong enough in his press conference. And all through January, you had a rally. Even in February, it looked like he was, we're almost done. You had a rally. And lo and behold, inflation showed up again. You want to know who's probably causing more inflation is Powell. Had he just back in July, not said anything, or at least came out the next day and say, okay, you clearly didn't understand me. Had he been firmer, maybe we wouldn't be here, So he's got to stop doing those bloody press conferences. How can U.S. government bond have a lower credit rating than Microsoft? Yeah, well, Microsoft is run by people with merit, professional people with merit. Your government is not run by people with merit. That's a big difference right there. You can count on Microsoft to make smart decisions. You can't count on your politicians to make smart decisions at all. At all. I really did not get the point of adjustment period and why you think the market... Okay, I already answered that. This one here is a long one. Well, let's read it, and if it gets too long, we'll move on. Narrow channel premise is based upon the idea that high unemployment is the only solution to inflation. How confident are you with that premise? Quite confident, because you do have a structural shortage of labor right now, and because you have a structural shortage of labor, let's say that is the capacity of the economy. Well, if you have a curve that looks like this, as you start adding more people, your curve's going to start doing this. It's going to start increasing, and you have a very sharp upward sloping labor supply curve right now because you're moving up against this sharp constraint. If inflation is due to supply-demand imbalance, in where we simply have more demand than supply, wouldn't it be true that although demand destruction is one way to bring inflation down, increasing the supply would be demand? Okay, well, how do you increase the supply of labor? That is the biggest shortage in the economy right now, is the supply of labor. There is more demand for labor if we believe all the numbers. If you look at all the labor numbers, they seem to confirm that, especially with initial claims. They seem to confirm that if you can't solve that supply constraint, what are you going to do? What line of thinking? The important factor to bring inflation down is not necessarily raising unemployment, but keeping those productive members employed so they continue to produce and supply goods or services. Here's the problem. You keep them employed so they produce goods and services. You still have this structural problem, but when you keep them employed, you still produce incomes and they spend. That's the problem, is they spend their money, therefore demanding goods and services, which then has to push up the price. Now, here is the more insidious problem is you have producers saying, we like prices going up. We don't want them to go back down. We want them to stay high and to continue to go on. GM is a good example of a company that says we are not going back to the days of thin margins on vehicles. Forget that. So what did they do with their plant in Indiana that makes trucks? They shut it down for a couple of weeks. Why? Because the supply channel has eased up and their productive capacity has increased and their inventory started building, and they said, whoa, on the inventory building. No, we need to keep this market tightly supplied. No inventory. Let's shut it down. Let's not make any more than we have to so that we can support these high prices, much like OPEC does. So now you have producers that would, if supply channels eased up, would put supply on the market to put downward pressure on prices, saying, no, Let's not put supply on the market to keep upward pressure on prices. So you now have some firms in the economy actively working for inflation. How do you break that? How do you break that? You got to destroy demand. You got to destroy demand so these people don't have money to spend unless you have forced savings where the government steps in and says 10% of all your wages now go into Social Security. Sorry, I got to force some savings on you. Well, now you can cut back demand by 10%, right? But if you did that, companies would lay off people because there'd be less goods or services and wages would go down on their own. Now, there is only one outcome, and that is to crush demand, and you can only crush demand by taking income away from people, because if you give them income, they will go and spend it. And when you have companies like GM actively working to promote inflation, wow, what are you going to do there, right? Key is reducing consumption. Yes, not necessarily production. So why wouldn't the Fed put more emphasis on the savings rate? Because they can't control the savings rate. All they can do to control the savings rate is push short-term interest rates up such that money market securities now pay 8%. And you start thinking, well, I could spend $1,000 or I could have $1,080 in a year if I get that 8%. They can just try to draw money into there, but there's about 70 to 75% of the population that are indifferent to the savings, to whatever money you earn on the savings, because they spend every penny they make. And there's nothing you can do because you have this thing called free will or free choice, whatever you want to call it. You have, actually, it's not free will, it's free choice. They have free choice. They're free to spend every penny they make, and they do. That's why I say it's either higher interest rates to separate them from their jobs or forced savings, one of the two. If the Fed raises rates high enough to where consumers choose to save versus consume by 10% but remain productive, wouldn't that be a much better outcome than raising unemployment by 10%? Well, it would still, if they save 10% of their income instead of spending every penny they make, it would take 10% of consumption away. And if you take 10% of consumption away, however you take it away, whether it's through forced savings or lost jobs, however you take it away, it's going to lead to companies laying off people because, well, it's 10% fewer things being made and demanded, right? Anyways, I think we can move past that. I've answered enough of that question, I think. What is the concept behind the Svensson model? What is its purpose? I don't know. I didn't look at it. Doesn't the idea of a soft landing rest on the idea of fairly robust population growth? Well, if you had good population growth, that could be a story because you could shift this supply curve for labor outwards, yeah. Otherwise, with the steady state workforce, it only pauses inflation, correct, which returns once the economy starts expanding again and requiring more workers from a tight workforce. If you have a good clearing out, in other words, you have companies that lay off a bunch of people, they will find efficiency gains. And they will replace people with automation such that in the next expansion, for the same level of output, they will require fewer workers. That's the beautiful thing about these recessions. It is you're redistributing capital from unproductive sources to productive sources. You're focusing more on efficiency gains than being effective at that point. And it just rejuvenates the economy such that it is in a much firmer foundation for growth. Manitoba, there are 3 people here and they're happy. I've heard that. Yeah. Have you ever considered adding a watch later or bookmark video option to your site? There is. When you first log in, there's a little menu that drops down, a little notice that drops down in the top corner telling you what the latest things are that have happened. At least I think there is. Couldn't find the 2017 video series. Oh, this was for the CFA. I did delete them all from my channel. Remember, I sold the business almost a year ago. They don't belong to me anymore, so it was only a matter of time before they left my site. If you go to markmeldrum.com, you can register for free, and you'll have access to the 2018 Level 1 series. Bring you over there because now you're in our website, and it is far more effective for us every now and then to say, hey, I see you're studying for 2018. Wouldn't you like the 2023 content? Get that? You see what's going on there? It's a way for me to get you into my house with some free candy. That's right. 44, 43, 43. You said that we can't have more people. We can't have more people in since a structural problem. No, I don't think I said that. I think we have a structural. The participation rate is not increasing because we have a structural issue. You can't. The labor force is not increasing at a rate. I shouldn't say the labor force. The participation rate is not increasing. And the population growth isn't increasing fast enough for that. More of the political reasons, but since Canada will have more immigrants than locals in 10 years, why are we just letting as many workers? Why aren't we letting as many workers as we need? At least it will be less costly since we will have the same outcomes anyways. I'm not sure what we're getting at there. Why wouldn't we let more in? I think we would. Why not? But immigration, you have to be very careful. There are two types of immigration, right? There's merit-based and there's familial. Familial immigration doesn't really solve a lot, especially if you're bringing grandparents over. So you land here and you're comfortable, and you start bringing perhaps your parents over who are retired. Well, they add to the population, they add to GDP in the sense that they're going to demand things like clothing and food, but they don't add to the productive capacity of the economy. So a lot of familial immigration isn't going to help our problem. It would actually just make it worse. So you got to make sure that the immigration you have actually helps alleviate a supply constraint, which is labor. 70% of people spend all their income. Is that just US? No, that is Canada as well. In fact, there is a research firm out of BC, and the name's right at the tip of my tongue and I forget it too. Several years ago, they put out a nice research paper on this. That 70% holds very firm for Canada as well. And that's the end of this one.